As you pay down a home loan, something quietly grows in the background. It is the portion of the home you truly own, called equity. Many homeowners do not realize they can borrow against that equity using a tool called HELOC. It can be flexible and useful. It can also be risky, because the home itself becomes the collateral. Let us slowly unpack how it works. HELOC stands for Home Equity Line of Credit. It is a revolving line of credit secured by the equity in your home. Instead of receiving one lump sum, you get access to a credit limit you can borrow from, repay, and borrow from again, much like a credit card. The key difference is that this line is backed by your house, not by an unsecured promise. First, let us define equity clearly. Equity is the value of your home minus what you still owe on it. If a home is worth a certain amount, and you owe less than that, the gap is your equity. As you pay down the mortgage, or if the home's value rises, your equity grows. A HELOC lets you borrow against a portion of that gap. A HELOC usually has two phases. The first is the draw period, when you can borrow from the line as needed, often making smaller, interest-focused payments. The second is the repayment period, when borrowing stops and you repay both the borrowed amount and interest, often with larger payments. Understanding this two-phase structure is essential, because the comfortable early phase does not last forever. The interest rate on many Helocs is variable. That means it can move up or down over time based on broader rate conditions. A payment that feels easy today could grow if rates rise later. Some Helocs offer fixed-rate options on portions of the balance. But the variable nature of many Helocs is a key risk that deserves careful thought before borrowing. Let us walk through a thoughtful example. Imagine a homeowner with solid equity and a stable income. They open a Heloc and use it for a planned home renovation that may add lasting value. They borrow only what they need, repay it steadily, and stay well within their budget even if rates rise. Here, the HELOC is a deliberate tool serving a clear purpose. Now a riskier example. Imagine someone treats their HELOC like a backup spending account, drawing on it for vacations, everyday bills, and lifestyle upgrades. Payments feel small during the draw period, so the balance quietly climbs. Then the repayment period begins, payments jump, and rates have risen. Suddenly the home that felt secure is carrying a much heavier load than planned. This is the heart of the HELOC risk. Because the loan is secured by your home, falling seriously behind on payments can put the home itself at risk. An unsecured debt that goes bad is a serious problem. A secured debt that goes bad can threaten the roof over your head. That difference should shape every decision about how much to borrow and why. So what are reasonable uses for HELOC? Many people consider it for home improvements that may preserve or add value, for consolidating higher interest debt with great caution, or as a carefully managed backup for genuine emergencies. The common thread is that the borrowing is purposeful, planned, and repayable. The HELOC works best when it funds something durable, not something fleeting. And what are uses that deserve real hesitation? Funding a lifestyle you cannot otherwise afford. Covering routine monthly shortfalls. Speculative bets. Anything where the spending disappears quickly while the debt, secured by your home, lingers for years. A simple test helps. Would you still feel comfortable with this borrowing if rates rose and your income dipped at the same time? There are also costs to understand beyond interest. Some Helocs have setup or appraisal costs, annual fees, or inactivity fees. There may be early closure costs in certain cases. None of these are necessarily deal breakers, but they should be known up front. A HELOC is a financial product with fine print, and the convenience can quietly hide some of the expense. A HELOC can also affect your credit profile. Opening it may cause a small initial change. How you use it matters too. A large drawn balance relative to the limit can influence how lenders see you. Steady, on-time payments build a positive record. As with most credit, the product itself is neutral. Your behavior with it is what shapes the long-term effect. It helps to compare HELOC with a home equity loan. A home equity loan usually gives you one lump sum with a fixed rate and a fixed payment. A HELOC gives you a flexible, reusable line, often with a variable rate. The lump sum suits a single known expense. The line suits ongoing or uncertain needs. Neither is better. They simply fit different situations. The variable rate feature deserves one more thought. During calm periods, a low payment can lull a borrower into comfort. But a responsible borrower plans for the less calm version. Before opening a Heloc, it is wise to ask, if my payment grew meaningfully, could my budget still absorb it without strain? If the honest answer is no, the borrowing amount may be too high. There is also a discipline trap unique to revolving credit. Because you can borrow, repay, and borrow again, a HELOC never naturally forces itself to zero the way a fixed loan does. Without intention, the balance can simply persist for years. So a smart user sets their own payoff target and treats the draw period as borrowing time, not free time. A few habits keep a HELOC healthy. Borrow with a specific, defensible purpose. Borrow less than the full limit, leaving a cushion. Make payments beyond the minimum during the draw period so the balance actually falls. Watch the rate environment, and revisit your plan whenever your income or expenses change meaningfully. A HELOC rewards attention and punishes neglect. It is worth remembering why a HELOC even exists. Your home equity is one of the largest financial resources many people quietly build over decades. A HELOC is simply a door to that resource. Doors can be useful and doors can be dangerous, depending on what you let through them. The equity took years to build. It deserves to be borrowed against thoughtfully. So here is the short version. A HELOC is a revolving line of credit secured by your home equity, with a draw period and a repayment period, often at a variable rate. It can be a flexible, purposeful tool, and it can also put your home at risk if misused. Borrow with a clear purpose, plan for higher payments, and treat your equity with respect.